Hi and welcome to Swissquote's Daily Market Talk. We're Wednesday, January 20th, and the week kicked off on a sour note in Europe, obviously, as tariff-exposed companies in Europe sold off heavily yesterday, while precious metals and their miners enjoyed a nice winter sun. The US was closed on the other hand, but the US markets will return from a long weekend to find out how their markets will react to the latest news about Greenland. The technology stocks and treasuries will be particularly in focus as Europeans could not only retaliate on the US big technology companies, but could also sell their US holdings, it is said. Is it even possible? I don't know. No one knows. Everything we learned and everything we knew so far are out of the window. So maybe yes, maybe not. Maybe this is just going to end up with another telco trade. Who knows? But we will still discuss about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the week started on a bad mood in Europe. Obviously, while the US was away, the European equities spent entire trading day trying to figure out to gauge the risk around Greenland and to what extent all this is seriously happening and where could this end? There are many dimensions to this problem, but the tariffs are one thing, obviously, and European companies, especially those with a greater exposure to the US economy and to the US market, took the strongest hit on Monday. These are last year's same old miserable group of names, including German car makers, for example, or the French luxury houses like Louis Vuitton. The latter slipped more than 4% on Monday's trading session. Now, the US markets were closed, as I said, but futures were trading and they fell. The technology-heavy Nasdaq futures, for example, lost more than the S&P 500 and Dow futures due to the risk of the big technology companies becoming the Europeans' target in this renewed trade and geopolitical tensions. And the US Treasuries joined Monday's sell-off this morning. In Asia, the US 10-year yield jumped past the 4.25% level on renewed tariff uncertainties. Also, the jump in JGBs as Takaichi there confirmed the snap election for February 8, and also the rising rumors that the Europeans could eventually weaponize their US assets. Yes, this is the language that's being used. Weaponize their assets, their holdings to fight back Mr. T's aggressive trade and geopolitical policies. In fact, the Europeans hold around 10 trillion US dollar worth of US assets, about $6 trillion worth in US equities, around $4 trillion worth in US treasuries and other bonds. Selling those assets would obviously pull the rug from under the US markets. And because Mr. T has a big focus on Wall Street, it could maybe get to him. But make no mistake still, this would also mean that the European investors, whether we are talking about private or public investors, would have to accept to be hurt financially to punish the USA. And right now, with the ongoing cost of living crisis, rising populism, aging population, and a clear delay in technological progress in Europe, it is quite hard to imagine people just selling their US holdings. Imagine, would you give up your Nvidia shares to buy Louis Vuitton? Tough choice. Anyway, the US futures suggest that the US will be following their European peers down when the week starts this Tuesday. In the US, the technology will be in focus, particularly, as I said earlier, not only because the Europeans could retaliate by punishing the US big technology companies, but also because the earnings there will gently start flowing in, with Netflix, for example, due to announce its quarterly results today after the bell. Now, Netflix is not an AI story, so it lost its relevance for the overall market mood, but the rest of the company's earnings will also be following in the coming weeks. And the geopolitical risk they're building right now around Greenland will be added to the risk list of circular deals in AI, over-leveraged investments, delayed ROI, and rising metal and memory chip prices. And as I've been saying since a while now, if you like technology, well, there are a lot of technology stocks outside the United States and they're doing just fine. Because the Kospi index, for example, in Korea gained every single trading session since this year started. Each single one of them. And that's because the memory chip makers are doing particularly well these days on the memory chip shortage, which allows them to hike the prices of their products pretty as much as they desire, simply because without memory chips, you can basically do nothing with the rest of your technology. And for the Europeans, I am just wondering whether ASML, for example, which is the only provider of EUV lithography technology, couldn't be weaponized as well. I don't know. Crazy thoughts are going through my mind these days. We are not used to this. We are not trained for this. So let's see how this goes. But beyond technology, there is a group of companies that did particularly well yesterday, and that's miners. Gold miners specifically, as gold prices continue to hit fresh record highs. The ounce of gold trading past the 4,700 level this morning in Asia, while silver is also consolidating a touch below the $95 per ounce level. As such, Frenilo, for example, one of the buzziest names of mining stocks, will jump more than 6.5% in London yesterday to a fresh record high level, and alone added more than 250 points to the FTSE 100 index. Endeavour, on the other hand, which is another gold miner, and Antofagasta, which is a copper miner, added another 150 points together to this index, helping the British blue chip index fall less than its European peers. And there is no doubt if the gold prices continue to rally, and it's hard to see what would reverse this rally when the news are so absurd, well, the rally in mining stocks will continue as well. Buying gold to defy the US has become a thing, the debasement trade, right? But I would still be careful with the exploding PE ratios of some of these mining companies today. Some of them are likely in a bubble. Frenilo, for example, today has a PE ratio of 76. And this is not technology stock. The supply here is limited, so most gains should come from price increases. So what's the potential, right? Even if gold prices doubled, what is the potential? Therefore, the price standing at 76 times earnings does not make sense to me. Endeavour's PE ratio in comparison is 18, which is already high for a mining stock, but it's still better. I would personally expect the PE ratio of a diversified miner like BHP, Rio Tinto, or Glencore to be around 6 to 10 times their earnings, and for precious metals miners around 8 to 15 times. Above that is just some heat that could come out. But anyway, coming back to the ugly world matters, the question today is this going to turn into another taco trade later this year? Some optimists point out that the Greenland saga of today is nothing different from the US now usual negotiation tactic. Punch first, talk later. But yeah, I mean, when you think we might have 3 more years of this, well, diversifying may be a good thing, I'm telling you. Diversify out of the United States and maybe also out of the US tech, because as I shortly mentioned earlier in this episode, this season of the stupidest trade war of the world history might see Europeans lose their patience and slap tariffs on the US big technology companies. But the problem is, where do you go? Besides the fact that the US big tech's appeal is hard to match elsewhere, and despite the Asian alternatives, the level of integration of these big technology services in Europe and their almost monopolistic status as technology services provider to Europe suggests that Europe just can't afford to lose them either. We can just not walk away. Americans know, as well as you and I do, that if the US technology leaves the old continent, well, there will be 2 choices. One would be to go with the Chinese tech. I know. It would be absolutely crazy, right? To replace your WhatsApp with WeChat, and well, you would be experiencing the incredible mega app that WeChat offers, but also you would see your messages, for example, disappear mysteriously time to time, blocked by the propaganda fighters. Or the other option would be just not have the technology anymore. No WhatsApp, no Word, no Excel, no social media, no nothing. Back to SMS, MMS, and maybe back to faxing? Well, that's hard to imagine, right? So my guess is that a market sell-off is preparing today, but a 15 to 20% pullback in global equities could be followed by another wave of taco trade. And you count 3 more years of this, hoping that the damage that is being done today among the Western buddies won't extend beyond these 3 years. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please Do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. I just opened a new Blue Sky account, so just come and find me there. And subscribe to our YouTube channel for daily market comments. And also do not forget to hit the like button to let us know that you enjoy these videos. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.